Welcome to FX Tech, your source for professional market analysis. This week, we're diving deep into the dramatic shifts in USD/JPY following a week of high-stakes central bank decisions and critical economic data. Is the dollar's dominance over the yen finally over? Let's break down the key drivers and what to expect next. The week of December 15th marked a significant turning point. USD/JPY fell nearly 1%, dropping from around 157.50 to 155.50. This yen strength was fueled by two main events: a historic rate hike from the Bank of Japan and surprisingly soft U.S. inflation data. The market sentiment has clearly shifted from bullish to neutral, with a notable increase in volatility and uncertainty. The long-standing narrative of a weak yen is now being seriously challenged. The Bank of Japan made a landmark move, raising its key interest rate by 25 basis points to 0.75%, the highest level in 3 decades. While this was widely expected, the market's reaction was paradoxical. The yen actually weakened immediately after the announcement. This buy the rumor, sell the fact response shows that traders are skeptical about the BOJ's ability to continue tightening aggressively. It's a clear reminder that forward guidance is what truly matters. Adding fuel to the fire, U.S. inflation data came in at 2.7%, well below the 3.1% forecast. This moderation in price pressures sent a strong signal to the market that the Federal Reserve has more room to cut rates in 2026. As a result, the probability of a rate cut by March 2026 jumped to nearly 46%. This accelerated timeline for potential Fed easing put significant downward pressure on the US dollar, providing a strong tailwind for the yen. For months, the wide interest rate gap between the US and Japan has been the primary driver of USD/JPY strength. Now, that gap is narrowing. With the BOJ hiking and the Fed preparing to cut, the lucrative carry trade is losing its appeal. The current differential is still around 3%, but the trajectory is what matters. This structural shift could lead to a significant reallocation of capital, driving sustained demand for the yen and long-term selling pressure on USD/JPY. The technical picture confirms this loss of bullish momentum. The short-term rising trendline has been broken, and the RSI has fallen below the neutral 50 level, signaling a shift to bearish sentiment. The MACD histogram is also below the zero line, reinforcing this view. The price is now testing the critical 50-day moving average around 154.12. While the long-term uptrend isn't invalidated yet, these are clear warning signs that the bulls are losing control. So, what are the key levels to watch? Resistance is firm at the recent highs between 157.48 and 158.00. To resume the uptrend, bulls need to reclaim this zone. On the downside, the first critical support area is between 154.12 and 154.31, where the 50-day moving average sits. However, the most important level is the long-term ascending trendline support between 150.83 and 151.00. A sustained break below this would signal a major trend reversal. In the short term, our outlook is neutral to bearish. We expect the pair to consolidate within a range of 154.00 to 157.50. The immediate risk is a failure to hold the 154.12 support, which would likely trigger a deeper correction towards 151.00. Traders should consider selling rallies towards the top of the range or buying dips near the bottom, but only with tight stops, as volatility remains high. Upcoming economic data will be crucial. The medium-term outlook is now much more uncertain. We see a 40% chance of a bullish scenario where the pair tests 160.00, but this would require the Fed to pause its cutting cycle. There's a 35% chance of a bearish scenario where the pair falls to 150.00 if the Fed accelerates cuts and the BOJ continues to hike. Our base case, with a 25% probability, is for range-bound consolidation between 151.00 and 158.00 as the market seeks clearer policy signals. This is a high-risk environment. The biggest risks are policy surprises from the Fed or the BOJ. Our strategy is to reduce position sizes and avoid chasing sharp moves. Wait for confirmation at key levels before entering trades. For long positions, use tight stops below 152.00. A weekly close below this level would invalidate the long-term bullish outlook. Discipline is paramount when navigating this level of uncertainty. To summarize, USD/JPY is at a critical juncture. The BOJ's historic hike and moderating U.S. inflation are challenging the dollar's dominance. The rate differential is narrowing, and technicals are weakening. Our short-term outlook is bearish within the 154.00 to 157.50 range, while the medium-term outlook is neutral. Manage risk carefully and wait for clear signals. Thanks for watching. Subscribe to FX Tech for more in-depth market analysis.